Welcome back, everyone. Thanks for joining us. Today we're going to talk about a very important topic, dividend growth investing strategy. It's very similar to compound growth. They are intertwined, but there are subtle differences that will make a massive difference in your portfolio over the long run. We all know that the returns of the S&P 500 have been very good over the decades. We can go back to the 70s here. What you see is the dividend payers, companies that regularly pay a dividend versus non-dividend paying stocks, returns are way different. But the one in green is the dividend growers and initiators. Those are the companies that regularly raise their dividends. Now, those are the ones we want to talk about today because that's what's going to make a massive difference in the long run to your success as an individual investor. If you like what we have to say, please hit that like button and subscribe to our channel. It will help us provide more content to you over the long term, and we hope you enjoy it. Now, this one here is probably the most important, most powerful slide I can show you. Is if you do not reinvest the dividends and you take the market returns, which are usually okay, you grew to about 350,000. But if you factor in your dividends and reinvesting those, you get 4 times the return. It is over a long period of 50 years. Not everyone has that time horizon, but the difference is stark no matter where you are on the graph. You always want to be that much more ahead because even a 1% difference over time can really build up. We're going to take a look at Canadian natural resources. What you see is in 2017, they had a 25-cent dividend, which they raised by a whopping 2.5 cents per quarter. Doesn't seem like a lot. That was actually a 10% gain in dividend. And what it did was every year they raised that dividend just by a little bit until it doubled in 2021. And then this year in 2022, oil companies were flush with cash, so they gave it a big boost. So it's gone from double to triple within a year. But what you see is on your original investment, it's already pushing that investment higher as the dividend goes up. And this is coming from the profits of the company. So very powerful. This is kind of a real life example of what the prior charts just showed you. And I think that's where you can see it in action. Another one, Canadian stock market. What you can see is on the right, the returns for the dividend growers are higher than the dividend payers and the index in general, almost double. If you have non-dividend payers and dividend cutters, poorer companies, those returns are negligible. But what's good to see is the annualized volatility. It means there are probably better downside protections when markets come crashing down. And that's where we've seen in 2022, after massive gains, we have a negative year in all markets. And this is something that will cushion the blow. It doesn't mean dividends are never going to drop. They will. Those stocks will also go down with the market. They tend to hold back on the way up, but I would rather have the safety. So that is another powerful tool on how you can gain extra returns over the general indexes as well. And just lower volatility in general. It makes us panic less. We make better decisions. Thank you very much. It's a quick video. Again, if you enjoyed the content, please give us the thumbs up on the like button and subscribe, and we will look forward to bringing back more content for you.